Welcome back. You're still tuned into Midcap Radar. Goldman Sachs in a recent report stated that peak oil demand is still a decade away. They've also raised 2030 demand forecast on oil. They add recent stagnation in EV sales raises the odds of the EV slow adoption scenario. Nikhil Bhandari, head of ASEAN Equity Research and co-head of APAC Natural Resources and Clean Energy Research, Goldman Sachs is joining us now in the studios to take a few questions on the energy outlook and a lot more. Nikhil, good afternoon. Thank you so much for joining us in the studio. And your trip from Singapore, I hope it's going very well in India. Tell us how it's been, India versus the other markets, and especially on oil demand. You know, we talk about a lot of investments happening in EVs, be it renewables. Do you think oil demand is still here to stay?
Yes, so thank you for having me back on the show, and it's good to be in person here in the studio. So we have concluded that we're about a decade away from the peak oil demand, and more like a plateau thereafter rather than a decline. This is more bullish than some other forecasters who have predicted peak oil demand before 2030 globally. In India's context, we believe oil demand will continue to grow through 2040. Okay. More importantly, it'll be the strongest driver from geography perspective among the large economies in terms of the growth contribution to global oil demand. This is despite we are still quite bullish on electrification and EVs. Globally, we sold 11% of new car sales as EVs last year. We believe this number will triple by 2030. In India as well, we are expecting a rapid electrification of two-wheelers and a gradual electrification of cars as well. The driver why peak oil demand is still away is because of the income growth. When we analyze the long-term pattern of developed market oil consumption relative to income growth, we find at a certain level of GDP per capita, there is a faster acceleration in the oil demand growth. So let me explain. So normally it's assumed that every dollar increase in GDP is a fixed level of oil demand increase. But we think it's an S-curve. There is an S-curve when growth hits a certain level. For example, when we are $2,000 to $3,000 GDP per capita, we are maximizing consumption of basic staple, protein, basic metals. We get more wealthier, we need more white goods, appliances, air conditioner. These are made of petrochemicals, which are made of oil. And then we go more wealthier, we need more car fleet and also flying demand. So again, India in particular will be in that acceleration phase of oil demand growth over the coming decades. So that should be accounted for in the oil demand outlook.
So you're not really seeing too much of a risk from rising electrification and also the rising mix of clean and renewable energy in the mix. Give us a sense of how you see refining category, how do you see refining margins play out for the entire spectrum?
Sure. So we are seeing limited capacity investments in the new refineries around the world. We have in fact closed 4% of the global refining capacity since pandemic started, while oil demand has returned to 1 to 2% above the pre-COVID level. So there is no spare capacity left in the system, and the newer builds coming in the next 3 years is still quite limited, while in a normal economic growth, we think oil demand will continue to grow at 1 million or plus barrel per day. So we think the refining system will remain stretched and tight in the medium term compared to upstream oil, where we think it's going to be more range-bound environment of $70 to $90 per barrel because OPEC has spare capacity, which they can release if demand surprises to the upside. But in refining, we don't have a cap here because the spare capacity is already quite limited.
So does it mean, I know you won't talk individual names, but in terms of themes, does it mean downstream will do better, especially standalone refiners, considering we don't have excess capacity coming in for a while now?
Yes, absolutely. So we are more bullish on refining within the oil supply chain, followed by oil, followed by gas, and followed by petrochemicals. So that's our pecking order in the oil supply chain. In the case of refining, clearly the spare capacity is the least. So indeed, we are more bullish. In the case of oil, we are more selective, and the keywords are free cash flow, access to growth projects, and access to, and companies who already have very high profitable project. I think that'll be the key consideration to pick the stocks. But as a theme, we think refining is more tighter as a more broad-based theme.
So you've looked at oil and gas names, both India as well as across the globe. So how does valuation pictures compare? So which ones look more favorable to you, and how do Indian companies compare versus their global peers?
Correct. So as I mentioned, the keywords, in those three keywords, we find more attractive opportunities in the upstream oil space outside India compared to India. That's where our top picks are more housed in. But as we look at our refining sector, we do think and anybody who's a merchant refiner who's selling more refined products at the international price will benefit from this theme. As far as valuations are concerned, the valuations do look little expensive on a cash generation basis on the Indian upstream and downstream energy names. However, that valuation constraint is more limited in the other area we cover, which we discussed last time, is, for example, the clean energy space, the power grid. That's a more unique opportunity in India, more longer multi-decade growth. That's where valuations will probably matter less, given the gestation of growth is even more longer term than the oil demand.
So in that case, you're saying that still some of the oil and gas names are trading at valuations which are maybe higher than the global peers. They are also making a lot of capex plans, be in renewables, be it in clean energy. I'm just speaking about the oil and gas space and the players there. And free cash flow is one of the reasons why you would like or dislike some of those names. Is this the natural progression from here on? Would that be something which would make you positive on that space?
I think where the investments are being made is important. We believe the more unique area of clean energy investments in India is round-the-clock renewables, because India's got two advantages. They've got a fully integrated grid, and they've got more sunshine than several other economies. So it makes a case where you can set up virtually different renewable facilities of solar, wind, storage in different locations connected to the one integrated grid. In that context, the bigger opportunity is in manufacturing of the upstream supply chain, which is the bottleneck. We are currently importing a lot of solar module and solar supply chain product, and we are also importing the battery product. So this is a core area where a lot more investments are needed in India, and it fits well in the broader India's stronger economics argument of renewable, round-the-clock renewable story. The bottleneck needs to be solved, which is the clean energy supply chain. So as long as the investments go in that direction, I think a growth multiple can be applied in that case. But if the investments go in an area where economics are not as strong for India in a unique way, probably the free cash flow drag will become more top of mind for investors.
What would those areas be where you do not see investments turning into profitable avenues?
I think it's still a little early stage in terms of making a profitable economic case for hydrogen at this point. For example, we don't have an economic argument of hydrogen in most parts of the world today. Green hydrogen I'm talking about. Right. So again, that's an area which is still needs to be tested whether economics can be achieved. So that's one example, for example, where investments.
Two quick follow-up questions. One is you spoke about the opportunity of renewable energy. How would you play that theme? Which are the sectors? What kind of companies will you look at? And secondly, when you're talking about renewable, there is always the problem of evening power peak, which the grid is not being able to meet. So how do you see a solution to that?
Sure. So firstly, we need the biggest opportunities are where the bottlenecks are, right? That's where investors then make returns. The immediate bottleneck we've been talking about for the past year is the power generation itself. Given we've added a lot of renewable capacities in the last 7 to 8 years without storage, and India's electricity demand has been growing at a very rapid pace. So power generation is the immediate bottleneck, followed by, to accommodate more round-the-clock renewable to solve for India's growing electricity needs, right, we need to overbuild the grid. Because when you have 100 megawatt coal energy, you have one cable connecting it to the grid. When you have 3 different facilities to make same 100 megawatt round-the-clock energy, solar, wind, storage, you need to draw 3 cables connecting to the grid. So we need to overbuild the grid, and that is going to be an important opportunity in the medium term, as we last time discussed. And third is the supply chain itself that we need to build, solar and batteries, to make so much round-the-clock renewable. So it's there's immense amount of opportunities in India clean energy space across generation, grid, and the supply chain for clean products.
There have been a lot of talks, investments in storage especially, because we do have round-the-clock sunshine, but not round-the-clock storage available right now. But thank you so much, Nikhil, for coming down and speaking to about different themes, what's happening in the clean energy space, and otherwise in the energy space as well. It was a pleasure speaking with you today.
Thank you so much for having me.
Thank you so much.
Thank you.
Okay, all right. With that, we'll do one thing. We'll slip into a short break. When we come back, we'll get you more on the markets and stock-specific action on the other side. So stay tuned for that.